Welcome back to the Deep Dive, where we slice through the complexity of quarterly earnings. Today, we're jumping into KKR Real Estate Finance Trust, better known as KREF, and their Q3 2025 earnings call. And this was a really weird one, a genuine head scratcher.
It really was.
I mean, if you just read the headlines, you saw a big miss. You saw negative earnings, light revenue.
A total miss.
But then you look at the pre-market, and the stock is actually up. It's showing relief. So how does a company miss its key metric and, get rewarded for it?
Well, that's the core tension, isn't it? It's the classic signal versus the noise. And our mission here is to figure out why the market just completely ignored that quarterly noise.
Right.
Investors weren't focused on a 3-cent miss. They wanted a roadmap. And this call, I think, really provided that. It was about the shift from credit triage to actual growth.
Okay, so before we get into that roadmap, let's just lay out the cold, hard numbers.
Let's do it.
So GAAP net income, that was actually back in positive territory, 12 cents a share. But the one everyone really watches, non-GAAP distributable EPS.
Yeah, that's the one.
That came in at negative 3 cents. And the consensus was looking for, positive 7?
A huge miss on paper. And revenue was light, too. It came in at about $31.5 million when the street wanted over 34. So yeah, a clear miss.
But this is where it gets really interesting.
This is exactly where it gets interesting. The market was looking somewhere else entirely. It was focused on stability.
And what did it see?
It saw that book value, the real core of the company, held steady. It was $13.78, down only like 0.4% from the last quarter.
So basically flat.
Basically flat. And second, they maintained the dividend, 25 cents. Given the negative earnings, that was a huge sigh of relief. The big takeaway was that this loss wasn't systemic. It was one specific action.
Clearing the decks.
Precisely. Clearing the decks.
So let's go there. Let's talk about that negative distributable earnings number, the source of all the pain.
Well, that negative 3 cents was driven almost entirely by one thing.
Which was?
A realized loss of $14.4 million.
Yeah.
That's the loss they took when KREF officially took ownership of a multifamily property in Raleigh. The whole REO process.
They finally just ripped the Band-Aid off.
They ripped it off. And the market rewards that kind of certainty. I mean, that Raleigh asset was a known problem, a high-risk loan. Taking the loss just eliminates the question mark around it.
And management was quick to point out the underlying number, weren't they?
Oh, absolutely. They said, look, before this one-time loss, our distributable earnings were actually positive 18 cents a share.
Okay, so that's the real number to watch.
That is the key number. It tells the market that once they get that capital back to work, they have a real path to covering that 25-cent dividend again. This is a one-time flush.
Okay, so they flushed that Raleigh issue. But what about the rest of the portfolio? I mean, are investors still worried about the overall credit profile?
That is the right question to ask. And you have to look at their defensive posture. They're not dropping their guard.
How so?
They've still got a huge CECL allowance. That's their reserve for potential credit losses. It's sitting at about $160 million.
Which is what, on a per-share basis?
About $2.45 per share. I mean, that is a massive safety buffer.
But there was another downgrade this quarter, right? The Cambridge loan. Doesn't that suggest that, the cleanup isn't quite done?
It does. It suggests it's ongoing, yes. They did downgrade that Cambridge Life Science loan from a risk rating of 3 to a 4.
And why?
Management said it was because they've started modification talks with the sponsor. So they're being proactive. They're getting ahead of it, starting the workout process now.
Transparent risk management.
Exactly. And if you zoom out, the whole portfolio's average risk rating is 3.1. Over 85% of it is rated 3 or better. So the issues seem to be pretty contained. It backs up that whole stabilization story.
Well, that makes sense. Okay, so triage is done. Wounds are bandaged. Now what? How are they fueling the recovery?
They had really strong execution on the capital side. First, they got $480 million in loan repayments. That's fresh powder.
And they put some of it to work buying back their own stock.
They did. Bought back over 448,000 shares at an average price of $9.41. When your book value is almost $14, that's a pretty strong signal.
But the big move, the one that I think really impressed the street, was about lowering their funding costs.
Oh, absolutely.
Yeah.
That was critical. They upsized their term loan B to $650 million, and they repriced it 75 basis points tighter.
Which means?
It means the new coupon is just SOFR plus 250 basis points. In this environment, locking in cheaper funding on a facility that big, that flows directly to future earnings.
And they're sitting on a mountain of cash. Liquidity was what, almost $1 billion?
$933 million. Near record liquidity.
Okay, but hold on. Isn't holding that much cash a huge drag on earnings? Especially when you just missed on distributable earnings.
That's a sharp observation. And normally, yes, it would be an anchor. But management was very clear this wasn't a strategic choice.
What was it then?
Purely a timing issue. They had one really big repayment come in earlier than they expected, and at the same time, their new loans, especially in Europe, just take longer to close.
So the message was, don't worry, we're putting this money to work.
Exactly. They expect the new originations to catch up to the repayment speed very quickly.
So if the capital's there, the funding is cheaper, where's the growth coming from? What's the pipeline look like?
This is a return to offense. Management is guiding for over $400 million in originations just in Q4.
And looking out further.
For 2026, they're targeting over $1.5 billion in repayments, which they said they fully expect to match with new, higher-yielding loans. That's a huge capital rotation.
But the really big story here, the thing that kind of makes KREF different, is the push into Europe, leveraging that whole KKR machine.
This is the pivot. It's a huge deal. They closed their first dedicated European loan in October. It's secured by 12 light industrial assets in France, around Paris and Lyon.
And they're not starting from scratch over there.
Not at all. That's the key. They're just plugging into KKR's existing global platform, which has already done over $2.5 billion in European real estate credit. It's a mature operation.
So why Europe? Why should we care that they're lending in France instead of, say, Florida? What's the opportunity?
It's all about market structure. It's really interesting. In the U.S., banks service about 40% of the commercial real estate market.
Okay.
In the EU, that number is 80%. 80.
Wow. So when European banks pull back,
it leaves a massive hole in the market, a much bigger structural gap for a private lender like KREF to step into and, get better terms and higher yields.
And the returns are there?
Management said that on a hedged dollar basis, the returns they're seeing in Europe right now are just as good as what they can get in the U.S. So it's great diversification without giving up any yield.
Okay, let's tie this all together. The big question is the dividend. That 25-cent dividend. We know the underlying business is earning about 18 cents. Where does the rest, that missing 7 cents, come from?
It comes from unlocking the value that's trapped in those non-performing REO assets.
The ones they just took over.
Exactly. Management put a number on it. They think there is 13 cents per share per quarter of embedded earnings power just waiting to be unlocked as that REO portfolio is stabilized and sold.
13 cents, so you add that to the 18.
And you're well over the 25-cent hurdle. It's all about redeploying that dead capital into new performing loans.
So what's the timeline? How quickly can they get that capital back?
They gave some really helpful clarity there. Yeah. They broke it down. So in the near term, call it 12 to 18 months, they expect to monetize about half the REO portfolio.
And that includes?
That's the Raleigh property they just took over, the West Hollywood condo sales, which are now actively for sale, the Philadelphia office, and a big one, the Portland project.
Right, the Portland project. They said parcel sales there should start in the first half of 2026, but it depends on entitlements.
Yes.
Can you just quickly break that down? What does entitlements mean in this context?
Sure. In real estate, entitlements is basically getting all the permits, the zoning approvals, all the regulatory sign-offs you need to legally develop or subdivide land.
So it's paperwork, essentially.
It's a lot of paperwork. It's a bureaucratic hurdle that takes time. But once you clear it, the value of that land goes way up because now you can actually sell it off piece by piece.
Okay. And what about the other half of the portfolio, the medium-term stuff?
That is mainly focused on their Mountain View, California office building. Management said demand there is picking up, but to sign a big lease, you need to spend money.
On what?
On CapEx and TI, capital expenditures for tenant improvements.
So they have to spend a bunch of cash up front to modernize the space for a new tenant before they can actually get rent checks coming in.
Exactly right. It costs money now to make more money later. It all fits the same theme, though. The focus is shifting from just managing problems to actively executing these recovery plans. So before we get to our final thoughts, we always like to do a little hypothetical thought experiment. A trade idea based on what we've just discussed. And of course, this is purely for entertainment. This is not financial advice.
Okay, so today's thought experiment is pretty simple. It's built on the thesis that KREF trading below $9 is just way too cheap compared to its almost $14 book value.
A bet on that gap closing.
Exactly. It's a bet on management's execution. Look, KREF is lagging its peers, But the path to recovery is now, it's clear, it's scheduled. You have the $1.5 billion in repayments coming in 2026 to provide the fuel.
And the whole KKR platform behind them.
Right. So the outrageous but plausible trade. It's a leveraged bet on that book value gap closing over the next, say, 18 to 24 months. You're betting that management executes on that capital rotation and successfully sells off Raleigh, West Hollywood, and Portland on their timeline.
A pure execution bet.
A pure execution bet. If they do that and they show the market they can consistently cover that dividend again, the stock price almost has to move higher, up toward that $13, $14 book value. So you'd structure something that gives you leveraged exposure to that upside.
A trade that lives or dies on those REO monetization timelines we just talked about. So to recap the whole call, I think there are three key takeaways. One, they stabilized book value. Two, they resolved a major credit issue with the Raleigh property. And three, they locked in cheaper funding with that term loan B repricing. The company has officially pivoted from defense to offense.
And here's the final thought for you to mull over. KREF is using its global scale to hunt for yield in Europe, in places like France, because the market structure is fundamentally different. So the question is this: does KREF's unique ability to leverage the entire KKR global machine to find these opportunities fundamentally change its risk-reward profile compared to all of its U.S.-only competitors? That's something to talk about. That's our deep dive for today. We'll catch you next time. And as always, remember, this content is for informational purposes only and is not investment advice.